Welcome to the Market Edge Tech Talk with Will Pauly and special guest David Blake. We're going to review the market conditions of the past week as well as longer-term trends from a technical perspective, take a closer look at the major indices, and to wrap it up, dig into a handful of individual stocks and ETFs requested by subscribers. If you have questions or want to submit a stock for next week's webinar, email us at support@marketedge.com.
Hello and welcome to the Tech Talk for Tuesday, August 23rd, 2022. I'm your host, Will Pauly, and I'm here with my co-host, David Blake. How are you doing today, David?
I'm doing good, Will. Thank you.
All right, let's start off with a look at what the market's been doing this past week. We'll look at the market ladder.
Okay. The major averages snapped, well, at least the S&P 500 and NASDAQ snapped their 4-week win streak last week. Kind of tumbled into the weekend. And it was kind of a mixed week the whole time period. We thought we were going to try to extend the gains off of the June lows when the week started, and then Monday and Tuesday, boy, the Dow and S&P 500 just kind of rammed into that 200-day moving average. They finished the period lower. We were able to shake off some kind of weaker than expected manufacturing data out of China and the U.S. On Monday and Tuesday. And then we also got some real nice earnings from Home Depot and Walmart. It kind of pushed the market to 4-month highs, which has been a heck of a move. As you know, I think they've rallied almost about 20% from the lows in mid-June. So we had a minutes from the FOMC meeting came out on Wednesday, and initially we saw kind of a knee-jerk reaction where the market rallied. Then it kind of rolled over in the afternoon, and part of that was triggered by Kansas City Fed President Tom Hoenig, who came out saying that the market's too enthusiastic about upcoming Fed moves on rates. And we had also had, I think it was James Bullard and a couple others came out and just said that we're still kind of we still feel well about pushing rates up possibly 0.75%. At the September FOMC meeting, which I think is around September 20th, so it's late in the month. So we have a couple more weeks yet before we're going to see that happening. But after he said that, we saw yields start to push higher, and of course, when the yields are going higher, the U.S. dollar moves higher. In fact, today we hit a 20-year high, I believe, in the dollar. So it's been pushing up pretty steady here over the last couple of weeks. We saw the 2-year T-bill finished around 3.25. The 10-year rate finished on Friday at 2.98. Today we are back over 3%. I might have gone over 3% yesterday. I'm not sure. It did cross back about 3% yesterday, and it ticked a little higher today. So that's something we'll talk about a little bit later. Of course, the strength of the dollar is going to hurt some of the multinationals as they have currency exchange problems when they start bringing their revenues over here. And then on Friday, once we got there, with the rates starting to tick towards their highs for the year again, we really had investors start to cash in their growth in big cap tech shares, and that sent the index down pretty sharply into the weekend. Let's see. We had defensive sectors were okay. We had some little bit of small gains in consumer staples, utilities, a little bit of energy. They were fairly strong, but the growth sectors like communication services, materials, financial technology, they were all pretty weak. We started to get talk again about demand concerns with oil. It actually fell to a 6-month low last week and went even lower yesterday at the open before starting to bounce back. We'll talk about that a little bit here later too. Anyway, so after you get done with Friday's sell-off, all the major averages were negative. Like I said, they snapped the 4-week win streak. The Dow actually has been down now 2 of the last 3 weeks. Technical condition of the market did deteriorate last week with that finish. Part of the problem was, like I said, when we ran into that 200-day moving average for several of the different indexes, they actually moved above it, and it failed to hold. That's something you want to watch, whether it's a stock or an index. when they bust through key resistance areas, you want to give them a lot of traders will say, I want to give it 3 days. If it can hold it for 3 days, then I think we're probably going to hold. Well, it just couldn't do it. And I think they struggled Wednesday, Thursday, and Friday going back and forth on that. So it was kind of it wasn't a confirmed buy signal to break through that resistance level. Okay, the Dow Jones outperformed a little bit, and they had its MACD on Friday was still it was just coming off overbought levels, but it was it was still positive. Momentum was still positive. S&P 500 and NASDAQ actually saw their MACD crossing the bearish territory, and we saw the 14-day RSI really slow down a little bit. That was something to watch. If you're new to these talks, a lot of the times we watch that 14-day RSI not just as a overbought or oversold level, but we noticed that if the 14-day RSI comes down, it should. If the bullish trend is going to remain, we'd like to see it stay above the 40 level. We'll take a look at that here midday to see if we're getting close to that. But I think we're getting close to it right today. So that's something we want to watch. If it's able to bounce off 40, then perhaps we can get a little bit of a bounce later in the week. We'll check that out. Another thing we look at is the secondary indexes, and by that I mean the small cap Russell 2000, and also the Dow Jones Transports, and even the Philly Semiconductor Index. And we like to see those secondary indexes kind of lead the market higher and lower. So last week they've been kind of outperforming the broader market, but last week we kind of got the red flag went up where they actually underperformed the market. We had the Russell 2000 and Philly Semiconductor were down 2.9% and 3.7% respectively, which is a pretty good hit for the week. We also had the Transportation Index, which was about where the NASDAQ was. It was down 2.5%. So all of them on Friday, all the different indexes finished period, back below their 200-day moving average. That's a negative. And we actually saw the Philly Semiconductor Index trade down to its 100-day moving average, which is another negative because it actually broke below that gap down yesterday, below that level. Underlying breadth was also it was pretty negative last week with the NYSE and NASDAQ AD lines both lost ground after 4 weeks of gains. And we also actually saw the new 52-week highs outdid the new lows on the NYSE for a second straight week. They actually did it. I knew it was going to be close. The NASDAQ AD line, NASDAQ new highs also outdid the new lows for a second straight week too. And if you remember going into the last 2 weeks, I think it had been 37 weeks where you've had more new lows and new highs on the NASDAQ. So there were some encouraging signs, not much, but you didn't want to just throw the towel in last Friday on what was going on. Investor sentiment finished in neutral ground. It's been overly bearish for quite a while. We saw a little bit of just a small uptick in the retail investors, but we did see the hedge funds on their exposure index. They actually pulled some chips off the table. They fell back to a 64% equity exposure from 71.6% just a week ago. So basically, so it's kind of a mixed week on that. A lot of stuff going on. We came in here yesterday, and we just opened sharply lower. Basically, what was causing that is coming off of some CPI, PPI. We started having investors talk about whether or not perhaps we might be able to see the Fed pivot a bit and actually start to think about maybe just letting off the gas a little bit on some of these rate hikes. I think on Friday, though, I looked, and we were about 50-50 whether the Fed was looking to hike either 50 cents or 75 cents in September. So that's they're not slowing down anytime soon. Yesterday it was pretty much across the board. The growth sectors were the weakest in big cap. We had more than 2% losses in communication services, technology, consumer discretionary, financials. We even saw crude oil prices tumble down to 86.70. Before, but they did rebound a little bit to 90.67. That was on some. It's kind of hard to explain. OPEC said they may want to reduce productivity because they want or production because they're worried a little bit about there's so much hedging going on, which we refer to as the paper markets, that's kind of screwing. It's just adding to the volatility of oil prices and even natural gas prices. And they think if they cut it down a little bit, it'll stabilize the pricing on oil. Whether it works or not, we'll have to see. But because of that, you also saw yesterday we saw the yields move a little bit higher. The 10-year T-bill again was back over 3%. 2-year ended around 3.32%. And basically what's happening here is we're starting to see that this 20% rally, like I just mentioned, was basically investors hoping that the Fed was going to let off the gas, and that has given them, brought money back into the market. But I think they're starting to finally say, you know what, I'm not sure they're going to. More and more Fed officials are coming out and saying, hey, inflation's still up here at 8-9%. What we've done so far it hasn't cut it, and we're going to have to continue to be very aggressive until we start to see inflation crack and move lower. Now, this Friday, the Jackson Hole Economic Symposium gets underway, and Chairman Powell will be talking on Friday. He'll give a speech on the economy and where they see rates going. That's liable to give us a bit of a clue. I don't, perhaps when they've seen what the market's done here recently with the last couple of days, falling off like this, maybe they'll soften their tone a little bit, but I think that's kind of wishful thinking. I think they need to stay vigorous in here and keep up the fight, even knowing they're probably going to err on going too far rather than come across as soft and have inflation move back up. So we've got a lot of work ahead of us. I don't really. Today we had some good earnings came out, for several different companies, but I don't think you want to be a hero and jump into this market, before Friday. We're still way off the highs, and if we're going to continue to, maybe move a little bit higher, you want to hear the Fed actually say that we are seeing progress in the steps we're taking to fight inflation, and perhaps maybe we'll just go a half point, or maybe we'll go a half point and reduce it down to a quarter. At that point, that's when I think you can become a little bit more aggressive on your picking up equities.
All right. So in Friday's market letter, you mentioned the major averages had rammed into resistance at the 200-day moving average. That was followed up on Monday by a big drop. And do you think it's safe to say that the rally is over for now, or should investors be looking to buy the dip?
I think I'd like to say it's over, I think there's a couple of things you want to watch. Obviously we've run up, very high, and now if Powell would come out on Friday and say, we are seeing progress, we're going to be data dependent, and we're not, we may want to start to slow down. You could get a little bit of a relief rally, and you can see these things maybe make another run back to the 200-day moving average. I don't know, and they may say the opposite, that hey, we've got our work to do. We're not slowing down. We got to make a dent in this inflation now and not stretch it out too much. In that case, you probably would see, the market go down. A couple of things I wrote about on Friday, coming off of back in June, when we hit our, we started to see a little bit of sideways. We had talked about the June highs where we wanted to see the market take those out, which we finally did here the last week or so. Which broke a bearish pattern of lower highs and lower lows. That was the first time we actually, after a bit of a sell-off, were able to exceed a previous high mark, and that gave me a little bit of hope that we would, maybe we could extend this rally a little bit longer. But now that we're trading down below that, I wanted to make some comparisons because right around that time we came out with more hawkish Fed talk, and I think they said they were going to raise the rates another 3/4 point in July, which they did. But we had the yield curve around that time. The 10-year Treasury had gone up to 3.48%. We're still inverted, I think, somewhere very close to it. And then after they raised rates, and they thought, okay, well maybe the Fed's going to pivot. The 10-year rate actually dropped all the way down to 2.57, dropped almost 90 cents on that, and that's when you saw the market kind of move up there. But as soon as they found out that it wasn't going to be, that they were still going to be pumping up here in July and September, that's when we saw the 10-year Treasury peak up there at 3.48%. That when the rate had dropped back down to 2.57, that's when the growth numbers started to come in. The growth stocks started to move. The technology, stuff started to move. But then you got, when you started coming out here with the committee saying, okay, we're hell bent on tackling inflation, and we're going to keep raising the rates a 0.5 to 3/4 point. Then all of a sudden, these guys that have been hoping that, okay, well, we're going to go into a recession. The Fed's going to back off a little bit. We can start to buy growth stocks in anticipation of them maybe not necessarily easing, but the longer term rates again. Like I said, just came back down almost 90 cents, which was a big drop. It's almost a 30% drop in rates, which is almost unheard of. But then again, we started moving forward here, getting more hawkish. The federal fund rates were back up to through almost 3.10, I think, on the 10-year now. We're getting 3.25, something like that, up on the 2-year, and we're starting. That's moving the dollar up, which is also giving a strong dollar is not the best thing for stocks, especially international stocks. So you're seeing that happen, and people are basically positioning themselves for the Federal Reserve to be a little bit more hawkish and more aggressive for a while longer. It's not going to be something they're not ready to pivot, and that's what the market was hoping. That's why we had such a strong 20% rally off of the June lows. So I don't think we're going to see that. I do think that we've probably seen the end of this rally. We'll come back down here. We'll see what happens over the next week or two, just to see if how the market's going to handle. I don't think that right now, with rising rates again and key resistance areas, the market could not break above. That's not something you want to be a hero and jump in and buy yet. As far as buying the dips, I think you've got to be selective. If you see something where all of a sudden maybe on Thursday or Friday that they say something and you have something where you want to say it's in the video or somebody, the video comes out with earnings tomorrow, they could be down. They could drop 15% tomorrow. There may be some stocks that you want to own for the long term. And by long term, I'm saying you want to hold this. You don't care if you make any money for the next 6 months, but you do want to nibble away while it's cheap. I think you can do a little bit of that if we on this next leg down. We may not get to the June lows. We may go down and put in a double bottom. Something like that would be, or just a little higher bottom. Something like that on the charts is kind of bullish, especially if we get down, maybe 10 or 5% above the June lows again. Then we'd be back in that pattern of higher highs and higher lows. That would be something to look at. But just to buy every dip and think we're going to be going higher in here, I think is the wrong strategy. I mentioned yesterday, I think you probably want to start hedging positions and look for weakness over the next few days as we go into the Jackson Hole Symposium, and just to see what Jerome Powell has to say. You're not going to miss anything. We're seeing slower growth. Today we got economic data that was again below expectations. We had new home sales were down for it's their lowest level since 2016. We had the August U.S. composite PMI fell to 45 versus 49. That's the lowest we've had since May 2020. These are numbers that are they're going to cause possibly negative growth for a third quarter, You know, you have an inverted yield curve, and you've already had 2 quarters of negative growth. You're kind of, you know, except for the jobs, you're in a recession, and we're starting to see already. Ford, I think, announced they're going to knock off 3,000 workers here in the next couple of weeks. You're having some other companies starting to say that they're going to be laying off workers too. So I'm still in the camp that we will be in a recession if we're not already in one. And because of that, I don't think you buy the dips yet, unless it's just something that you have wanted to own, and you just look at it and say, you know, this thing is so cheap now. I'm going to nibble a little bit at it. If it goes lower, I can always buy some more. So that's where I'm at. We'll get a clearer picture again on Friday when Powell speaks at the Jackson Hole Symposium. And I would expect the market to be pretty volatile on Wednesday, Thursday, and Friday, just as we see this. You know, some investors are going to hope that he's going to be more dovish. Others are going to think he's going to be more hawkish, and you're going to see some wild swings, I think, in the market. Either way, I think the smart thing would be to stay on the sidelines. Our CTI looks like it will be rolling over and going negative for probably the next 6, 7, or 8 weeks. That's historically had a great track record of calling weak periods in the market, and that's also kind of confirming that, you know, as we see the deterioration in the underlying internal breadth of the markets indexes, that I think we're going to be in for some more weakness over the next couple of weeks, and I would be cautious, you know, and just kind of watch from the sidelines.
All right. Well, that's all we have for you this week. Remember, if you have a question you'd like answered in the next Tuesday Tech Talk, email it to support@marketedge.com or ask one of our live chat representatives to pass your question along to us for the next Tuesday Tech Talk. Thanks for tuning in, and we'll see you next week.